Picture this. While you were scrolling through social media and worrying about everyday expenses, China quietly executed one of the most massive financial maneuvers in modern history. We're talking about moving $350 billion. That's not a typo. $350 billion with a B. But here's the kicker. They didn't move this astronomical sum into stocks, bonds, or any traditional investment you'd expect. They converted it into strategic materials that can be used in conflict. And this strategic shift is sending shockwaves through financial capitals worldwide. Yet most people have no idea it's even happening. Today, we are uncovering a story that reveals how the world's second largest economy is preparing for what many experts believe could fundamentally reshape the global order as we know it. And by the time we're done here, you'll understand exactly why this matters for your financial future, regardless of where you live or what you earn. Picture this scene unfolding in Beijing boardrooms during February 2022. Chinese leadership watched with alarm as Western nations executed what many consider the most audacious financial maneuver in modern history. Within hours of Russia's invasion of Ukraine, the United States and European Union froze $300 billion of Russian central bank reserves. Money that Moscow believed was safe in Western financial institutions simply vanished with a few keystrokes. For China's Communist Party, this moment represented an existential awakening. They realized that their massive holdings of American debt weren't actually assets at all. They were hostages waiting to be seized. At the time, China was holding over $1 trillion in U.S. bonds alone. This revelation triggered what we are witnessing today, the most systematic and deliberate dismantling of financial ties between two superpowers since World War II. China isn't just selling American bonds. They're methodically preparing for economic warfare by converting paper promises into physical reality. What they're doing with the proceeds will shock you. Let's start with the numbers that should terrify anyone holding long-term American debt. According to the latest Treasury International Capital Report, China's official holdings of U.S. Treasury bonds have collapsed to $688 billion as of October 2025. To most people, that sounds like enormous money, but here's the context that changes everything. At the peak of what economists called Chimerica in 2013, China held $1.32 trillion in American debt. They've liquidated nearly 48% of their position. That's over $600 billion of American IOUs dumped onto global markets. But the truly alarming part isn't the total amount. It's the timing and the speed. Throughout 2024 and 2025, American bond markets experienced historic turmoil. Interest rates swung wildly and bond prices crashed in many periods. Anyone selling Treasury bonds during these windows was selling at a massive loss. In asset management, you never sell a depreciated investment unless you're facing immediate cash needs or you believe the asset is about to become worthless. China isn't facing cash problems. Despite domestic real estate struggles, they continue generating massive trade surpluses. They're swimming in dollars. So why would they willingly take losses of 10 to 20% on bond sales? Because they've concluded that American Treasury debt represents a strategic liability that could become completely worthless overnight through sanctions. This is sanction proofing in real time. Chinese leadership studied what happened to Russia and drew a chilling conclusion. If tensions escalate over Taiwan or the South China Sea, their treasury holdings won't just lose value through market forces. They could be completely frozen or seized by American authorities. The $688 billion they still hold effectively becomes a donation to the U.S. Justice Department the moment sanctions are triggered. So they're getting out with extreme urgency. The velocity of recent sales tells the whole story. In October alone, China shed nearly $12 billion in bonds. Central banks typically hide their selling to avoid spooking markets. They sell slowly in small batches. But Beijing's recent dumping suggests they're less concerned with market stability and more focused on capital flight. They want their money out of American jurisdiction immediately. This creates a massive problem for the United States. For 2 decades, the American government could run enormous deficits because China acted as the ultimate buyer. They purchased Treasury debt regardless of yield because they needed to recycle their trade surplus. That automatic buyer has not only disappeared, but become the biggest seller. This should have crashed American bond markets and sent interest rates through the roof. But curiously, that hasn't happened yet. Why? Because as China exits, American allies are being forced to step in and absorb the supply. Look carefully at the Treasury data, and you'll see a disturbing pattern. While China's line item plummets towards $600 billion, other countries show historically abnormal increases. The United Kingdom's Treasury holdings have surged to record levels reaching over $750 billion. This puts Britain neck and neck with China as America's second largest foreign creditor after Japan. Think about that for a moment. The UK economy is roughly 1/6 the size of China's. Britain doesn't run massive trade surpluses. In fact, they run trade deficits. So where is Britain getting $750 billion to lend to America? They're not earning it through exports like China did. They're likely borrowing money or using financial engineering in London's banking sector to buy American debt. The UK is effectively leveraging its own balance sheet to act as a shock absorber for American bond markets. Then there's Belgium, showing holdings of roughly $320 to $370 billion. Belgium isn't suddenly flush with cash, but Belgium hosts Euroclear, one of the world's largest securities depositories. When you see Belgium buying American debt, it's rarely the Belgian government. It's usually other central banks or sovereign wealth funds trying to mask their purchases through proxy accounts. This surge in UK and Belgian holdings occurring exactly as China sells suggests coordinated intervention by Western allies. This is financial conscription. Washington is essentially telling its partners that China's dumping threatens the entire global system. If allies don't step in to absorb this supply, American bond markets break, and if American bond markets break, the global financial system collapses. But this strategy has a fatal weakness. China had seemingly infinite capacity to buy American debt because they were the world's factory, earning real dollars by selling real goods. The UK and Europe lack that capacity. They're already struggling with debt burdens, slow growth, and expensive energy transitions. By forcing them to buy Treasury bonds, Washington is draining liquidity from its own allies. This creates fragility throughout the Western financial system. If the UK economy stumbles, as we saw during their pension fund crisis in 2022, they might be forced to sell those Treasury holdings to raise emergency cash. If that happens, the backup buyer disappears exactly when America needs support most. China understands this vulnerability perfectly. They're playing a deliberate game of financial attrition. Every $1 billion of bonds they dump forces the Western financial system to find $1 billion of liquidity to absorb it. This draws capital away from productive investments like factories and infrastructure, forcing it instead into the black hole of refinancing American debt. It's a weaponized sell-off designed to exhaust Western financial capacity before any military conflict even begins. China is bleeding the West dry while preparing their own defenses. This shift fundamentally changes the nature of American debt markets. They used to be dominated by economic buyers like China and Saudi Arabia who purchased bonds for profit and trade recycling. Now they're dominated by political buyers like the UK and Belgium who buy for diplomatic survival. Political buyers are unreliable. They purchase until their own voters revolt or their own currencies crash. We're watching the transformation from a global reserve asset to a NATO reserve asset. The market is shrinking while debt issuance is expanding. Meanwhile, China is taking their sale proceeds and running to the one place American authorities cannot touch, the physical world. When China sells a treasury bond, they receive dollars in a custodial account. But China doesn't want dollars anymore. Dollars are traceable, sanctionable, and subject to inflation. So what are they doing with the roughly $700 billion from this massive bond liquidation? They're engaging in the most aggressive commodity accumulation campaign in modern history, converting paper claims into physical reality. First, there's the golden pivot. Chinese authorities have officially purchased gold for over 18 consecutive months. Unofficial data from Shanghai Gold Exchange withdrawals suggests the buying is much larger than reported. They're using dollars from bond sales to purchase metal in London and Swiss markets, then shipping it east. Gold represents the ultimate anti-dollar asset. It has no counterparty risk and cannot be frozen through banking systems. By swapping American debt for gold, China is moving from credit-based reserves to collateral-based reserves. Second, they're building an energy lifeline through crude oil stockpiling. China imports 70% of its oil, representing their strategic weakness. In any conflict, American naval forces could blockade the Strait of Malacca and strangle the Chinese economy. To counter this vulnerability, China has been purchasing record amounts of oil, often from sanctioned nations like Iran and Russia, paying in yuan and bypassing dollar systems entirely. Crucially, they're filling their strategic petroleum reserves to maximum capacity. Recent analysis indicates China's crude stockpiles are approaching 1.5 billion barrels of combined commercial and strategic storage. Satellite imagery shows construction of massive new storage facilities and underground caverns. They're building buffers that would allow survival through naval blockades for months or potentially years. The funding for this oil comes directly from American asset liquidation. Third, there's what I call the metal mountain strategy. China's property sector, historically the biggest consumer of copper, is in depression. Real estate construction is down dramatically. Yet China's imports of copper, ore, and concentrate remain near all-time highs, with roughly 28 million tons imported in 2024. This defies economic logic. If you're not building apartments, why do you need so much copper? Because they're shifting to a war economy. Copper is essential for green energy infrastructure to reduce oil import dependence. It's crucial for munitions manufacturing. It's needed for drones and electric vehicles. China is cornering markets on the physical inputs of 21st century military-industrial complexes. They're also hoarding cobalt, lithium, and rare earth elements. While America financializes its economy, China is materializing its savings. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications, because what's coming won't be explained on the evening news, but it will be explained here. Fourth, they're constructing a food security fortress. China produces 20% of global GDP, but controls only 7% of the world's farmable land. This represents another critical vulnerability. In response, Chinese authorities have accumulated massive grain stockpiles. According to U.S. Department of Agriculture data, China holds approximately 60 to 70% of global corn and wheat reserves. They've stockpiled enough grain to feed their population for over a year without any imports. They're trading bond yields for caloric survival. This represents a fundamental mindset shift. Nations planning to remain peaceful keep wealth in efficient interest-bearing instruments like Treasury bonds, chasing maximum returns on investment. Nations preparing for conflict convert wealth into inefficient physical stockpiles. Holding 500 million tons of copper pays no interest and costs money to store. It has negative yield, but massive return on survival. China is willingly accepting lower financial returns today to ensure they cannot be economically strangled tomorrow. This explains why they're taking losses on bond sales. Western economists mock this approach, claiming China sold at market bottoms and realized billions in losses. This reflects short-term thinking. Beijing doesn't care about mark-to-market losses in currency terms. They care about resource security. If they sell a bond at an 80% loss, but use proceeds to buy oil they'll desperately need if shipping lanes close, that's a winning trade. They're swapping fake wealth that can be frozen or inflated away for real wealth that can fuel engines or fill ammunition. The Treasury liquidation is the funding mechanism for this national stockpile. They're using proceeds from the old system to build bunkers for the new system. Now let's examine what this means for everyday investors. For 40 years, the 60-40 portfolio combining 60% stocks with 40% bonds was the gold standard of investing. Bonds provided the safe haven, the ballast that kept portfolios steady during market storms. That era is ending. American Treasury bonds are no longer risk-free assets. They've become political footballs in a global economic war, assets that depend on the kindness of strangers who are increasingly becoming enemies. If China, the ultimate insider of global manufacturing, is exiting these markets, you need to ask yourself a serious question. Why are you staying in? Here's how to position yourself for a world where the biggest buyer becomes the biggest seller. Follow what I call the survival protocol. Rule 1. Shorten your duration exposure. If you hold bonds, you must understand duration risk. Duration measures how sensitive bond prices are to interest rate changes. Long-term bonds like 20 or 30-year Treasury securities have high duration. If interest rates rise by 1%, 30-year bond prices can crash by 20%. As China exits, structural pressure on long-term rates is upward. Even if the Federal Reserve cuts short-term rates, the long end of the curve depends on supply and demand, not Fed policy. If China sells and the UK eventually taps out, yields must rise to attract new buyers. Rising yields mean crashing prices for existing bondholders. Therefore, avoid long-term government bond funds. These assets are most vulnerable to Chinese selling pressure. If you want safety and yield, keep cash in short-term Treasury bills, 1 to 6 months maximum. Short-term bills have almost zero duration risk and act as cash equivalents. Be like China, get liquid, get short-term. Don't lock money up for 30 years with a government fighting an economic war. Rule 2, follow the smart money into commodities. China is selling paper to buy physical assets. You should consider similar positioning. Your portfolio needs exposure to energy, metals, and real assets. This isn't just about profit potential, it's about inflation protection. Think about the endgame scenario. If China dumps $688 billion and allies eventually stop buying, who purchases American debt? The Federal Reserve. The Fed will be forced to step in as buyer of last resort through yield curve control. They'll have to print trillions of dollars to monetize government debt. When they print trillions, dollar values fall and commodity prices rise. This creates an inflationary feedback loop. China understands this dynamic perfectly. That's why they're buying physical assets now. You should own producers of these commodities. If China is hoarding copper, own mining companies that produce copper like Freeport-McMoRan or Southern Copper. If China is stockpiling oil, own energy producers like ExxonMobil or Chevron. If China is accumulating gold, own the metal directly. These assets hedge against currency debasement. You want to own the stuff, not the currency that buys the stuff. Rule 3, monitor the allies for warning signals. You need early indicators of when the Western support system is breaking. Watch currencies of key American allies, specifically the British pound and Japanese yen. These countries are straining their resources to support dollar bond markets. Japan, in particular, is the largest holder of American debt while fighting their own currency crisis. The yen has been highly volatile. If Japan has to intervene to save their currency, they'll need to sell Treasury securities to get cash for yen purchases. If Japan joins China in selling American bonds, it's game over for low interest rates. Watch the dollar-yen exchange rate carefully. If the yen crashes toward 160 or 170, or if Japanese bond yields spike dramatically, it signals the support alliance is fracturing. That's the moment the Federal Reserve will be forced to intervene with massive money printing. That's when the pivot happens. Not because inflation is defeated, but because Treasury markets are broken. The 688 billion figure isn't just a statistic in a government report. It's a countdown clock. China is methodically removing itself from the American financial system. They're clearing the decks for what they see as inevitable conflict. They're willing to accept losses today to ensure survival tomorrow. Don't interpret current market stability as safety. It's artificial stability propped up by political pressure and borrowed money from allies. When that support gives way, the adjustment will be violent and sudden. The smart money is already moving. China, despite their massive size and global integration, is willing to take enormous losses to get out of dollar-denominated assets. The message is clear. Get out of long-term debt, get into hard assets, and watch the financial flows carefully. The economic divorce between superpowers is being finalized. We're just waiting for the house to be sold. The countdown has already begun, and the smart money is already moving. The question isn't whether this system will break, but when, and whether you'll be positioned on the right side of history when it does. China has drawn their conclusion from watching Russian assets get frozen. Dollar-denominated debt is a strategic liability in an era of financial warfare. They're acting on that conclusion with unprecedented speed and scale. The era of Chimerica, where China funded American consumption while America provided security guarantees, is officially over. What comes next will reshape the global financial system in ways we're only beginning to understand. The countdown clock is ticking, and the exodus has already begun. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.